The bull market is stampeding. Are you riding it or getting trampled? Jim Cramer breaks down why today's market rally is broader and more powerful than skeptics want to admit, sharing hard-earned lessons from decades on Wall Street Watch until the end as Cramer reveals the stocks and sectors leading the charge, plus the pitfalls that could catch investors off guard.
We're getting more than a tad nervous about what would happen 2 weeks from now. For much of the tremendous run over the past decade, critics love to point out that most of our gains were coming from a small cadre of tech stocks. First, it was FANG, Facebook, Amazon, Netflix, and Google. Then it became the Magnificent Seven: Alphabet, Amazon, Apple, Meta, Microsoft, Nvidia, and Tesla. Over and over again, as the market roared higher, we were told that the rally was so narrow that it could not be sustainable. You couldn't have a handful of companies that were worth trillions of dollars, then hundreds of stocks in the tens of billions, but nowhere near the valuation of these tech titans. Made no sense. They told us it was only a matter of time before these false idols would be smashed and your gains would go up in smoke. I get that view. I've heard it all my life. There was a time I even believed in it. But if you're actually in the market every day from scratch, trying to notice what doesn't work, what can get you hurt, what can keep you out of tremendous gains, then you know there's another way this situation can play out. Sure, narrow rallies can collapse in on themselves. That can happen. Or, you know what they can also do? They can broaden out. And then the market keeps chugging higher and higher, chugging higher and higher without the sages who told me to get out. See, I learned this lesson way back in 1988. I know, a long time ago. But we had one of those summers where only a handful of stocks led the market. I grew increasingly worried that I was riding the same stocks over and over again, especially, yes, tech stocks. I was haunted by the notion that I was somehow whistling past the graveyard because a bull market with so few participants just had to collapse under its own weight. Sell, sell, sell. I used to hang out with a lot of other portfolio managers, hedge fund hotshots, you know, the analysts. They all said the same thing. It's too narrow. You had to do some selling. You had to do a lot of selling. Then ultimately, you had to get short. And so, because I was young and not particularly discerning, I took their advice. I sold many of my longs and began to put my put options on stocks that were similar to my biggest winners, kind of as a hedge against the looming crash. Why not? We just had a crash the year before. Why couldn't we have another one? Heck, we were due, weren't we? But the crash never came. Instead, a narrow summer rally developed into a wider fall upswing and then turned into a full-bore, multiple-sector stampede. Fortunately, I was able to sell the put options, but many of the stocks I'd hedged went up, and the stocks I'd shorted moved up too. That canceled out my upside. I finally got long enough, bought enough stocks in the early to late fall that when I stopped talking to other money managers and decided to take my own counsel, well, let's say I made a lot of money, and I never again let the breadth of a market drive me into a short stance. Instead, it was the opposite for me there going forward. I was always on the lookout for the kind of widening of leadership that can crush the shorts like the widening we had today, because I never wanted to get steamrolled by a runaway bull again. Right now, we have a runaway bull for certain. In fact, it's a bull jailbreak, for heaven's sakes. And the bovines are running rampant, trampling the bears who were possessed with the narrow nature of what brought us this high to begin with. They were staying short. They still are, probably. In turn, look at the other totems. Look what's working. How about stocks like JP Morgan and Goldman Sachs, two stalwart financials, both going crazy, or Caterpillar and Boeing doing quite well. The communication stocks plowing ahead. Sometimes, though, it helps just to look at what's working on a given day. So, in recession, I called up the top 10 winners in the S&P 500 today, just to see how broad the list might be. It proved that what I learned in 1988 was a stock market life lesson, one of the few benefits of getting old, and the one I'm giving to you now. At the top of that list, that sainted list today, Enphase Energy. Oh boy, a roughed up solar company. Oh, what's driving that? Possible congressional break that could preserve some solar tax credits. Then it was Freeport McMoran. That's the copper miner. Copper's been a loser for years, but periodically the Chinese order tons of it, or we buy it in bulk for the data centers. I don't want to own Freeport, even as copper is up 25% for the year. Freeport's a trading vehicle, and we don't do that around here. Sell. But it certainly demonstrates the diversity of this top 10 list. Next is Albemarle. This is a chemical company that produces lithium. I honestly don't know where this one's coming from. We haven't suddenly seen a surge in electric vehicle sales that I've seen, or any tax credits in the congressional bill. It's broadening out mystery. Could be happening. Then we've got McCormick, the spice company. This one's a shocker because most of the food stocks have been left for dead. Turns out some parts of the food industry are getting it right, and their stocks are going up. We've got McCormick on tonight to find out more. Next, Coinbase. All right, the cryptocurrency stocks, they just never want to quit, and this is a group that matters. Even if older portfolio managers don't care, look the other way. I think this one's going higher to who knows where. There was even a tech stock, and it isn't a magnificent one. We're talking about Arista Networks, which makes networking equipment, longtime Cramer fave. After that last quarter, some thought that Arista had lost a step. I didn't see it that way, but you had to wait a bit before it seemed to matter. There was another data center play. This time it's Supermicro, an important partner of NVIDIA. Now, I think that not Supermicro, I think Dell's the right investment in the space. But there's no denying that this stock is doing quite well. Then there's NRG. I mean, it's part of a small group of utilities known for their relatively clean power. And a lot of tech companies want clean energy for their data centers. NRG works directly with them, and it also partners with GE Vernova, a charitable trust holding that makes the turbines for their power plants. We then had Insight. That's a biotech company. It just got a new CEO, Bill Murray. He's an industry veteran known as a deal maker. Makes sense. Murray was previously the CEO of Karuna Therapeutics, which he sold to Bristol Myers for a very nice premium. That better start working soon. Before that, he was chief commercial officer at Allergan. It's a company famous for its deal making. Finally, rounding things out, we have APA, the old Apache. Can run, but it can't hide. This is an oil and gas company, primarily natural gas. Apache's been a huge disappointment over the years. Maybe now that it's APA, it won't be. Well, anyway, maybe M&A's picking up. I had to wonder whether there's something going on here because otherwise it shouldn't be going up. I still prefer Coterra for natural gas. Still, no denying that Apache's cheap versus assets and no denying that it's not a tech company. Here's the bottom line. For years, we were warned that our rallies were too narrow. Now we got a broad leadership group. Today was a solar, couple of minerals, crypto platform, 2 data center stocks, a utility, biotech, and a natural gas producer. That's what I call a real broad, bullish rally. Everyone who warned you that the market was too narrow to go higher is now either closing out their short positions or getting their faces ripped off.